Mortgage insurance companies are not equal. That's what I want to share with you today. Those of you that are not regular listeners of the show, I do mortgages as a full-time career and just hang out here with you on the weekends for a little money chat and the money hour. But mortgage insurance companies, if you're coming in with less than a 20% down payment, you're going to be paying private mortgage insurance. You'll have to figure out how you want to pay that. And I'm going to go over some options here. But what most consumers do not know is you actually have options as far as the mortgage insurance company. Now, I should step backwards, not options that you get to make a decision. The mortgage consultant that's representing your financing and the mortgage company are shopping or not shopping for mortgage insurance. So just to be clarification, you do not have the ability as a consumer to shop mortgage insurance, but your mortgage consultant does. What's important is to be asking the question if they have options to work with all mortgage insurance carriers, because majority of your major banks or credit unions, they're typically going to have one carrier that they use just for system purposes. And a lot of times it may not be the best carrier that's going to be the lowest cost option. So most consumers don't realize that mortgage insurance and the cost of PMI is different depending on the mortgage insurance company that you go with a lot of the time. Sometimes the pricing is going to be the same, but other times are not. And the reason why is because of how their algorithms actually price mortgage insurance. So there are 5 major carriers for mortgage insurance. You have Genworth, United Guarantee, MGIC, Radian, and Essent. So some of the mortgage insurance companies are straightforward in how the pricing is. Other ones are based on, again, the algorithms that they use on the risk factor. And it's looking at a lot of different categories. Now, every mortgage insurance company is going to be based risk factor, obviously, on credit score. So if you have a certain credit score, you're going to get a better pricing model, just like you would on a mortgage interest rate or anything else that you're shopping for. Credit score is going to determine what that cost for that product or that option is going to be. Now, loan to value, all mortgage insurance companies are going to be straightforward as far as your loan to value. So if you're coming in with a 5% down payment, you're going to pay a premium mortgage insurance, versus if you're coming in with a 15% down payment, the cost of your mortgage insurance or private mortgage insurance. I'm saying both mortgage insurance or MI, more known your PMI for private mortgage insurance. Same thing. What most people don't understand is there's at least 2 of the mortgage insurance companies are based on risk factor on other items. Property location is a big one. So depending on where your zip code is at, when you run the pricing through the 5 different mortgage insurance companies, 2 of them are going to have better pricing model or a higher pricing model depending on the other factors. So if you're buying a home in Bellevue versus buying a home in Tacoma, mortgage insurance is at a higher risk in the South End, statistically, everything's based on statistics, than what you're going to have in Bellevue. And a lot of different risk factor or pricing can be in different states. But just in zip codes in my location, if I'm running it in Tacoma versus Bellevue, I may see a different pricing structure. Debt to income ratio is a big one as well. Now, again, not all mortgage insurance companies have a difference between debt to income ratio. You either qualify or you don't. But there are 2 mortgage insurance carriers that the lower your debt to income ratio, the better cost of mortgage insurance is going to be. Now, I've seen a huge difference in the cost, especially when you do a single premium or what I call a buyout. I've talked about buyout of mortgage insurance a lot in studio during my money chat, and it gives you an option not to have to pay private mortgage insurance on a monthly basis, but instead just buy it out and you can actually finance it into your loan. It's really awesome. So we could be looking at a difference of 1.75% to maybe 2.25% in the cost, just based on that one factor in your debt to income ratio. Now, here's another one, number of income borrowers that you have on the loan application. Now, if you think about this, it really does make sense. If you were lending on the risk of that mortgage getting paid back, wouldn't it make sense to you that if you have a spouse situation or a borrower and a co-borrower where both of them have income, both employed and working, that you would have a less of a risk that they're going to default on the home, which ultimately it's the purpose of mortgage insurance, is to protect the bank in case the consumer defaults on that home loan. So it's a less risk if you have 2 income borrowers. So there are a couple of mortgage insurance companies that will price differently based on the fact that you have 2 income workers versus just 1 income worker. So those are just a few different things that can be indicators. And most important is just to ask the question, does your mortgage consultant have access to all the mortgage insurance companies, and have them run the analysis and send over the PDF report. You can look at it and you can say, here, see all the 5 mortgage insurance companies, what the costs are, to make sure that you're securing the best price, or that your mortgage consultant is securing the best price for you. Just to recap again on mortgage insurance options for those of you that have not heard me talk about this in mortgage during my mortgage chat, because it's really important, and I run into consumers all the time, day in and day out, and referral partners that don't know that there are different options to pay mortgage insurance. You can pay it, as everyone knows, on a monthly basis. That's the standard way that you're going to pay mortgage insurance. You can also do what's called a single premium. I call it a buyout because it's just a one-time buy it out. It's just my term for single premium. You can do a lender pay. Lender pay basically means there is no mortgage insurance cost that you're going to see anywhere. Now, where you're going to pay it is you're going to pay it in a higher interest rate. I'm not favorable to that option unless it's a really short-term loan. My favorite is a buyout. If I were purchasing a home myself or refinancing and I had to pay mortgage insurance, I would do the single premium buyout option. And then you also have what's called a split. A split is just what it sounds like. It's a split in a combination of 2. It's a split of the monthly and a split of the single premium. So you're going to pay a lower single premium than you would with a complete buyout, and you'll pay a lower monthly than you would with a complete monthly, and you're split in between the 2. I don't know. I just make a decision whether you want monthly or you want buyout is my thing. But anyways, you've got options, and that's most important. Again, getting a mortgage, getting anything else that you're going to secure, options is really what it's about. It's just weighing out the different options that you have to make the best financial decision for you and for your family. Coming up next in the Money Hour, our King County Assessor in studio right now, Lloyd Hara, here to share recent things happening at the assessor's office and your property taxes. Again, right here on 1150 AM KKNW after this short break.